Yeah. The next chapter is completely into the risk and returns calculations, and half of this chapter is already dealt in quant. Now, starting off with these terms: holding period return, arithmetic return, geometric return, money weighted rate of return. These are all the terms which we have computed as well as interpreted as a part of our quant space, because here the portfolio is very closely looking at risk versus return. How do I minimize the risk and maximize my return? Right. So this part is talking about the return, the different types of returns. So the most common forms of returns being your holding period, arithmetic. So holding period return, especially when you are having it for a single period, we look at it as a holding period return. If I buy now, sell after some time, holding period return is appropriate. But if I am looking at it as an annual return or something, then either arithmetic mean or geometric mean is appropriate. Especially if my investment is for less than 1 year, arithmetic mean is more appropriate. Investment is for more than 1 year, a CAGR, which is a geometric mean, is more appropriate. And if I have multiple cash flows in the middle, the IRR, which is the money weighted rate of return, will be more appropriate. Right? Even if it is a lump sum, for a lump sum, depending on whether the investment is for less than a year or more than a year, if I want to annualize that return, I'll go either for arithmetic mean or for a geometric mean. But if there are more cash flows happening in the middle, every year some money is coming in the form of dividends or interest or some things, then IRR, which is the money weighted rate of return, will be more applicable. The other forms of returns typically to look at are: one is a gross return, which is more like whatever is the profit I got on this investment, any investment I am doing, whatever is the profit I got, minus the commissions that are involved in it, because any buying and selling, there is a brokerage charge. The brokerage charges that are involved in it, and any kind of selling costs. The cost of returns is the costs that are incurred to generate those returns, which are more like your selling costs. So all these things, when I subtract, that is what I call as a gross return. So this does not consider the fund management charge, fund administration charges. If I take them out also, I call them as net return. Right. So which is more like net return will always be lesser than gross return by the extent of management and admission fees. So typically annual management charge, if it is 2% or something, so my gross return, if it is 11%, my net return will be only 9%. Right. And whereas the original return is the increase in NAV. If the NAV has gone up from 10 to 12, so the return is 20%. Minus, let's say the brokerage is 1%, 19%. Minus the selling costs are 2%. 17% is the gross return. And out of that 2%, let's say, is the fund management and admission charge, your net return is 15%. So depending on, so sometimes when a fund advertises, you have to clearly see what is the return they are talking of. Is it a plain return, the first one? If that is the case, what is the gross return and the net return? Because what typically the investor has to bother about is the net return. After deducting all the fund management charges and the administration, the sales, everything, all the costs deducted, is what is the return which is actually received by the end investor. So even if one fund is giving 18% and another is giving 20%, for the same amount of risk, probably I may have to evaluate in the terms of what are the costs, what are the fund management charges. If the 18% guy is charging only 0.5%, whereas the 20% guy is charging 3% as the fund management fee or costs, any other costs, then probably we are losing out by going with a 20% investment, 20% return fund compared to a 18% return fund. So that's where I have to evaluate the gross as well as the net. Then one more focus is the pre-tax versus post-tax. Again, in some cases, the taxes also play an important role. Right? If I am completely into a bond fund, probably there is a good chance that there is an exemption from exemption from taxes for some of the bonds in which I have invested. Or money market, there might be an exemption from the taxes for the money which has been invested. Or government bonds, if the fund is investing heavily in government bond, there could be a tax exemption that may come. So we have to see the returns pre-tax as well as post-tax wise, and even the inflation. Some funds are there which will invest in inflation adjusted securities, which means if the inflation is high, that security will give higher return. Inflation is lesser, they give lesser return. So they are more protected against inflation rather than the other securities where in whatever is the inflation, the return is going to be like this. So I have to look at both nominal as well as real kind of returns. And the most important aspect is the leverage return. Very much applicable where heavy borrowings are involved. For your hedge funds or today most of the trading which people are doing is on a margin basis. Borrow, invest. So if it is profitable, it becomes heavily profitable. Probably you will generate 100% return. If it is loss, you are making 100% loss also. So that is where we'll talk about the leverage return, because you are putting in, let's say simple logic. Let's say you have 1000 rupees with you. If you are going on a cash mode, if the current share is 100 rupees per share, you can get 10 shares only. See, you have 1000 rupees with you. 100 rupees is per share. So you can get 10 shares only totally. So let's say the share price has gone up by 10%. So what will happen to your money? The share would have gone to 110 rupees a share. When you sell off all your 10 shares, you will get 1100. So there is a 10% profit for you, straightforward. Even if it is the 10% loss, you will lose 10%. But how the leverage model works is, let's say you have 1000. By putting this 1000, the broker will lend you another 9000. So overall you are having 10,000 with you. With this 10,000, you can buy 100 shares of this company. Right? Now, if you assume that the share price will go up by 10%. So 110 rupees. 110, your total value is becoming 110 into 100. So which is becoming 11,000. When you are selling off, you are getting 11,000. Out of that 11,000, you will return 9,000 to your broker. 2,000 you are left with. That's your money. You have invested 1,000, you are getting 2,000. There is a 100% profit there. Same thing will happen the other way also. If the share price goes down to 90 rupees, the total value is becoming 9,000. Out of that 9,000, you are refunding that 9,000 back to the broker. You are left with 0. There is a 100% loss also. So both are possible in case of leverage. Whenever you are getting, but today most of the trading happens on the leverage basis only. So because of that, there is a huge risk that is involved. So the plan out or the portfolio management has to happen more or less in a very judicious manner to avoid these kind of losses. Okay. So I think these calculations are quite comfortable for you. If the annual return for the last 3 years were 6%, minus 30% and 20, you can find out the holding period return. Right, 1.06 into 0.7 into 1.2. That is your holding period return. To the power 1 by 3 if you do, that's a geometric mean. Right. And just simply add up and take an average, it becomes the arithmetic mean. 6 minus 30 minus 24 plus 20 minus 4 by 3% is your arithmetic mean. Just a brushing up of your quant fundas itself. An investor evaluating the returns of 3 recently formed exchange traded funds. So the fund 1, 146 days old, it has given a return of 4.61%. Fund 2, which is 5 weeks old, it has given a return of 1.1%. And fund 3, which is 15 months old, it has given a return of 14.35%. Now, if I have to compare which one is doing better, it's better to find the effective annual return of each of them. These are the holding period yields. So for the holding, you can find out the effective annual yield from the holding period yield. The way you can very well do is, in the first case, I'll do it as 1 plus 4.61%, 1 plus holding period yield to the power 365 by n. 1 by number of years. Number of years is 146 by 365. So it becomes 365 by 146. This will become the effective annual yield for the first one. For the second one, what it becomes? 1 plus 1.1% to the power 52 by 5. 52 weeks. 1 by number of years is 5 by 52. So make it 52 by 5. This will give you the effective annual return. So whichever is having the highest, you will choose, that is your investment. Same thing will go with the third. 1 plus 14.35% to the power 12 by 15. Right? 1 by 15 by 12 years. 15 by 12 years is making it 12 by 15. Yeah. Now the question is, find the real rate of return and the risk premium for these equities. How will I get the real rate of return? From the nominal, take out the inflation. So for the equities, the nominal rate of return is 8%. The inflation is 2.1%. So if I am taking it out, it is becoming 5.9%. That becomes my real rate of return. And what is risk premium? RM minus RF. RM minus RF is my risk premium. So RF is nothing but the return that comes on the treasury bills, government securities. So 8 minus 2.5, which is 5.5, that gives me the risk premium. So generally 2 calculations are asked for. Either do a real rate of return calculation wherein you take the influence of inflation. If you are looking at risk premium, you are primarily adjusting it with respect to the risk-free rate of return. Risk-free rate of return in a normal case is the return which can be obtained on a treasury bill or government securities. Computing all these things, this is another topic in this. So probably a quick revision with your quant will again bring you computing the mean, that probability and the returns are given for one security, 2 securities. So finding out the mean, variance, covariance, correlation, all those aspects. So just brush up with your quantitative, because they have an application even in portfolio management also. So the same question can come either under the quant heading or under the portfolio management heading. Now, for us, as a part of the execution phase, we said we need to look at different kinds of asset classes. And the theories were very clearly point out, the higher the risk, higher is the return. So historically it has been observed that treasury bills will have the lowest amount of risk. Then long-term treasury bonds, again government bonds. Treasury bills are more short-term. Long-term ones are slightly risky because government may default. Right? Then long-term corporate are slightly more risky. Large cap stocks, which are like all established company shares, all big company shares, they are less risk, they are slightly more risky. Small cap stocks are much more risky. Probably I don't know any company, not too much of known company, If I'm trying to purchase the shares of that company, we don't know, I may lose completely on that. Right? So this is the kind of order which we see in terms of the riskiness. Again, when we are saying riskiness, we are trying to look at only two aspects, right? The mean, which is through the return, the standard deviation, which is through the risk. Now, what is the assumption here? We are looking only at the two factors, whereas for every data we said we need to look at four factors. Skewness and kurtosis also. But here we are not looking at skewness and kurtosis. We are only looking at mean and standard deviation. This is applicable only under the assumption that my data is normally distributed. The data here is nothing but returns. If the returns are normally distributed, which is the case in most of the returns, if the returns are normally distributed, we can say skewness is 0, kurtosis is 0. So if I just try to evaluate the data from mean and standard deviation standpoint, I can get a big picture about the data. But if at all I find that the data is more deviating from a normal distribution, in some cases I may find negatively skewed distributions, skewness is not 0, or leptokurtic, the kurtosis is not 3, above 3, right? In those cases, I have to take some more caution in terms of identifying what could be the expected return out of this asset class. Right? Either I have to adjust it to normal by doing some kind of outlier analysis, or I may have to use some other distribution altogether. Because the only mean and variance, mean and standard deviation analysis will work only when your data is normal in nature. Though most of the time people assume that the asset returns are normal in nature, you have to really test out for this asset, let's say for Infosys stock, are the returns more normally distributed? If they are more normally distributed, I can still go with mean and standard deviation and assess this is the average risk, this is the variance in the risk. This is the average return, this is the risk. So based on that, I can work it out this could be a 95% interval, all that kind of hypothesis testings and confidence interval buildings and all can very well be done. But if it is not normal, all my numbers will differ. And probably the risk management world focuses more on non-normal distributions, very heavy. And apart from that factor, I should also look at the liquidity nature. Right? How well I can convert it. Now if it is not liquid, let's say real estate property is there, it's illiquid. If I want to sell off, I may not sell off at the current price. I may have to sell it off at a much lower price. Or I may take more days to sell off and get cash out of it. Then we are calling as less liquid or illiquid kind of. So if there is a highly illiquid instrument, there is a big risk. That risk also should figure out into the return. So whenever we are looking at different asset classes, apart from the historical data observation, I might also need to consider more from a liquidity standpoint or more from its distribution standpoint to identify where it actually fits in. If it is more and more negatively skewed data, then there is a good probability that the loss will occur. Right? See, it will not be a symmetric. So 95% confidence interval will not be same from both sides of the mean. Right? There is a chance of the values going down drastically. So if I have to look at the 95% area under the chart, more than 50% will be towards the left of the mean. So that is what will create more and more chance of value going down and less chances of value going up. So my expected return is actually getting disturbed. Right? My probabilities, my confidence intervals, everything is getting disturbed because most of those assumptions, if you remember, the confidence intervals and all which we built are under the assumption that the returns are following a normal distribution. 1.96 or symmetric distribution at least. Even in case of T, T also we said it's a symmetric distribution. But the moment we see that it is not symmetric, the probabilities, the 95% intervals and all, the construction mechanism completely changes because more value should be left and very less towards the right. So the profit chance is much lesser, the loss chances are much higher. So that's where identification of the asset classes should happen accordingly. Then, now we'll come to so these are the return side. Returns wise, we are looking at different classes or different types of returns and how do I compute the various calculations. Now, from a risk standpoint, let's look at the investors. Investors can be classified into three categories: risk averse, risk seeking, risk neutral. Risk averse are general investors. Most of the investors are risk averse. Simple funda is, if there are two securities which are giving the same amount of return, same expectations of their return, he'll choose the one which is less risky out of the two. Or if there are two securities which are having the same amount of risk, he'll choose the one which is giving high expected return. That's a common investor psychology. That is what we mean by risk averse, which means he is willing to take additional risk only if he is compensated accordingly. Right? Whereas when we talk about risk loving investor, he wants to take the highest possible risk. It's as simple as putting, if there are two securities with the same level of risk or with the same level of return but two different risks, he'll choose the risky one, not the non-risky one. Right? Average return could still be the same. Right? Here, why is he looking at average return is still the same. Let's say a lottery versus investing in a stock market. Probably the average return could still be 10%. But the risk is more higher in a lottery compared to a stock market. A risk averse investor will think of investing in a stock market in that scenario. Whereas risk loving investor or risk seeking investor, he'll invest in a lottery. Because if something comes, he'll get a big jackpot. So he is more willing to take that kind of a risk. Average return is same in both. Expected return is same in both. But one of the values could be extremely high. He wants to aim at that. So that's what will be the characteristic of a risk seeking investor. Whereas when we say risk neutral, he is literally neutral to both. He has no choice. I mean, he has no priority. He can go with this, he can go with this. He is not bothered about whether it is more risky or less risky. Both of them are neutral. As long as I am getting more returns, I'll go for it. Right? Expected return is his focus. Wherever it is high expected return I am getting, I'll go for it. So a risk neutral investor's focus is high expected return. Risk neutral and risk loving investors, risk averse and risk loving investors, if there are two securities with the same expected return, risk averse guy will choose the less risky one, risk loving guy will choose the more risky one out of the two. And yeah, this is the formula which we have discussed even in quant. The variance or the standard deviation of the portfolio. W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus 2W1 W2 covariance between A and B. And as we have discussed already, if the two securities are positively correlated, fully, highly positively correlated, then there is no diversification benefit. The correlation, if it is moving away from 1 towards -1, the diversification benefit is coming more and more and more, which means the securities standard deviation, the portfolio standard deviation is actually getting reduced. The portfolio standard deviation is getting lesser and lesser And based on that, probably if it comes close to 0, it's like I'm creating an assured return. If I'm able to bring the portfolio standard deviation close to 0, I'm able to bring in an assured kind of a return. In some cases, it is possible to bring it to 0, especially when I have -1 as the correlation. Right? Wherever there is a possibility of, if I'm able to identify two securities which have a correlation of -1 between them, I can very well create a zero risk scenario. Zero risk scenario, if I am able to generate a return, it's like a risk-free return itself. So that is how the hedge fund guys will look at. Create a portfolio in such a way that the sigma of the portfolio is 0. And make sure that the return will be 10%. 8% is the risk-free rate of return. 10% is your return. You are able to get 2% more, which is what is adding up to your, and that 2% you will leverage based on heavy volume. Because both are having zero risk. Zero risk, this is giving 8% return, this is giving 10% return. Obviously, this becomes the most preferred kind of an investment with a 2% extra profit. They play on that. Right? And if there is no diversification benefit, better put all your investment in the security which is having the least standard deviation itself. If both of them are having a correlation of 1, there is no point in investing in two different securities. Choose the one which is having the least standard deviation out of the two. And what happens is, as the number of securities increases, that is, let's say a mutual fund, 30, 40 securities he invests, the correlation between each pair of securities becomes a very important aspect. Because if it is between 2, I can choose, probably I may get the combination -0.5. But if I want 30, getting all minuses would be a very difficult thing. So planning out on my correlations is a very important aspect there. The importance of correlation becomes more and more, especially when I am dealing with large number of securities. And what we have to see is, sometimes the return does not play any role in the risk of the portfolio. In the formula, there is no question of return at all. No expected return. The formula contains only weightages, standard deviations of each of the individual securities, and the covariance or the correlation between the two securities. Right? Return doesn't play any role. And if the assets have a perfect positive correlation, their portfolio standard deviation, let's expand the same formula. W1 squared sigma 1 squared. Right? Let me write it. W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus 2W1 W2 covariance I can write it as correlation into standard deviation of 1 into standard deviation of 2, because correlation is nothing but covariance by standard deviation of 1 into standard deviation of 2. Now I assume, let's say the correlation is 1, perfectly positive correlated. Now this equation is nothing but W1 sigma 1 plus W2 sigma 2 whole square. W1 squared sigma 1 squared, W2 squared sigma 2 squared plus 2W1 W2 sigma 1 sigma 2, which is nothing but W1 sigma 1 plus W2 sigma 2 whole squared. So the variance of the portfolio is equal to this. Standard deviation is the square root of this, which will come out as W1 sigma 1 plus W2 sigma 2, which is nothing but weighted average of their standard deviations only. If the two securities are perfectly positively correlated, the weighted average of the standard deviation of the portfolio is same as the weighted average of their individual standard deviations. Because there is no diversification. It does not come down. It's a simple weighted average. Whereas when they are not positively correlated, there is some reduction from there. So it will definitely be less than W1 sigma 1 plus W2 sigma 2, because some amount of a diversification benefit is getting applied, and because of that the value will definitely, the maximum value could be W1 sigma 1 plus W2 sigma 2. It can fall below that, but it cannot go above that. Right? Now, yeah, this is these are the 2-3 important terms which we need to look at. One is the minimum. Probably let me demonstrate this entire thing through an Excel data. All right, let me take two securities, A and B. Right? So I'll take returns. A is expected to give a 12% return. B is expected to give a 20% return. The standard deviations, I have found out, let's say A is having a standard deviation of 10, B is having 15. Right? And correlation, let's take it as, let's say 0.5. Just we'll look at the numbers. Based on that, I'll take covariance. Covariance, we can get it as correlation multiplied by the standard deviation of 1 into standard deviation of 2. So this is what my covariance is. Now I want to consider different scenarios of investing. Okay, I'm now looking at creating a portfolio with only A and B. Simplifying scenario, with only A and B, I want to create a portfolio. So A, B. Let's say I can do 100% investment in B. I'll put 0% in A, 100% in B. Or I'll do 10% in A, 90% in B. Like this I can do. So I'll take some scenarios. So I can put any of these percentages here. I can put any of these percentages here. Right? So probably 60% in A, 40% in B. Now based on that, I can calculate the return of the portfolio and the standard deviation of the portfolio. Both can be calculated. Probably let me do the variance of the portfolio using that formula, and the standard deviation of the portfolio, again, which is the square root of variance. So the return will go as W1 R1 plus W2 R2, weighted average, simply. So which is becoming W1 R1 plus W2 R2. So if I put my entire money in B, my return is 20%. Now I am dragging it down. So if I put my entire money in A, I'll get 12%. And anywhere in the middle, my return would be in the middle. Because it's a weighted average, it will lie between the minimum and the maximum value. So it will lie between 12 and 20. Whereas with the variance, that's not the case. It changes with the correlation between them. Okay, for time being, we'll take the variance using our formula. We'll compute the variance using our formula W1 squared sigma 1 squared, that formula right here. W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus 2 W1 W2 correlation, or probably I'll directly take covariance. Correlation into sigma 1 into sigma 2, I'll take covariance. So this is what is the variance of the portfolio. And if I take the square root, probably here itself, let me take the square root. Why do we need one more? So I'll call this as standard deviation of the portfolio directly. For whatever I have got, I'll take the square root of this entire thing. Square root of this entire thing is giving me the standard deviation of the portfolio. So here, because 100% in B, the standard deviation will be the same as B standard deviation. Now when I drag it down, when I put 100% in A, the standard deviation is same as A standard deviation. But in this process, look at it. Let me just change the format of it. Now you see, there are change times when the standard deviation has actually come to 9.84%, which is lesser than the standard deviation of any of them. So which means I can reduce the risk compared to investing individually in each of the securities. By making a 90-10 combination, 90% in A and 10% in B, I can reduce my overall risk. Right? By doing it 90% in A and 10% in B, I can reduce my overall risk. Right? So if I am looking at a risk mitigated investment, then this is looking more and more comfortable for me, rather than any others, or probably rather than putting 100% in A, 90-10 is looking like more risk mitigated kind of an investment from my side. Right? So what we are saying is, now when I try to plot the graph between these two, taking the risk on the x-axis and returns on the y-axis, for different combinations, probably we just took with a gap of 10%, but probably I can take it with a gap of 1% or half a percent. In reality, every quarter% also will have a big impact. Right? So I want to plot one simple graph with risk on the x-axis, which is standard deviation on the x-axis, and return of the portfolio on the y-axis. Let me just try to plot that graph. So on the x-axis, I'll take the risk. On the y-axis, I'll take the returns. When I'm looking at this graph, this particular graph is more and more like a curve. There is a kind of a small curve that is coming up. You will see the clarity in the curve. You are seeing there is a small curve that is coming up, right, because of the square and square root relation that is coming up. So the shape typically will follow a kind of parabola, especially when you have a squared and square roots kind of relationship. You will find the curve following a shape of a parabola, not a straight line. Now that is the reason behind this particular risk versus return graph of a portfolio, where we are talking of different combinations of investments. Now in this curve, there are 3-4 points for us to look at. When I look at it from a perspective of risk averse investor, that's a typical thing any finance instrument will focus on. Risk seeking and risk neutral are investor specific, but the pricing of any investment goes under the assumption of every investor is risk averse, because he is ready to take that extra risk only if he is compensated with extra expected return. If expected return of both of the things is same, he will not take an extra risk. That is taken by a risk loving investor, right? Now from this standpoint, for a particular rate of return, there are different layers of risk. In this scenario, if I want 15% return, my risk is something. If I want 20% return, my risk is something. If I want 13% return, my risk is something. Now, if you look at this graph, for each return, what is the risk? Because there could be different investors with different kinds of return expectations. Now, I could be with 10, you could be with 11, you could be with 12. So, for each return, what is the level of risk? What is the amount of risk that is required? If I try to join all those points, I get a curve like this. This particular curve is what is called as the minimum variance portfolio curve, which means a guy who wants 15% return, the minimum risk he has to take is somewhere around, probably somewhere around 8.49%. The guy who wants 17% return, probably he may have to take a risk which is 9.85%. Right? That's the minimum risk which a person has to take for getting that much of a return. So for each level of return, that's what it says. For each level of return, what is the least possible risk? When you join all such points, you get a curve. That curve is called as a minimum variance portfolio. Minimum variance for each level of return. Minimum risk for each level of return. In that, wherever you are at the extreme left, where the risk is the minimum possible, right? Probably at 8.32%, the risk is the minimum. So what combination? 70-30 is the combination where the risk is minimum possible. And that particular portfolio, 70-30 investment between A and B, is what is called as a global minimum variance portfolio. Because if I am looking at A and B, the minimum I can reduce the standard deviation is to 8.49%. I cannot make it 0. I can bring it to a minimum of 8.49%. That is the global minimum variance. So with this combination of A and B, the risk cannot be reduced below 8.49%. That is what we call as a global minimum variance portfolio. Now, when we use the word efficient frontier, the meaning is slightly different. For each level of risk, see earlier when we used the minimum minimum variance portfolio, we looked at it from a return perspective. For each level of return, what is the minimum risk? Then all the values are covered. But look at it from the x-axis perspective. For each level of risk, what is the maximum return I can get? A person who is willing to take a 10% risk, there are two possibilities. Right? For a 10% risky person, so if I look at it from a risky guy's risk perspective, If I am looking at it from a return perspective, for each return there is only one risk. But look at it from a risk perspective, for each risk, in some cases there are two returns. And obviously when we are talking about a risk averse person, when there are two combinations with the same level of risk, he'll obviously choose the one which is giving higher return. So the numbers will be applicable only in the upper side of the curve. The graph will be relevant. If I look at it from a risk perspective, the graph would be relevant only in the upper part of the curve, not on the lower part. Because all these lower part portfolios, combinations, will become valueless, are not preferred by the investor, because if he is ready to take 10% risk, so if he is ready to take 10%, probably a 100-0 combination is giving him 12% return, whereas a 40-60 combination, almost 10% risk, but he is getting 16.8% return. So he'll always prefer the one which is giving the 16.8% return one. So what will happen is, the ones which are on the bottom slope going down, they become inefficient. They are called inefficient portfolios. And only on the top part, they are called efficient portfolios. The reason is, now as the risk levels of the person are increasing, the returns are also increasing. Right? That's a basic panda. But when we are trying to plot the graph between risk and return, up to some extent we got the risk increasing while the returns are decreasing. Right? But then people will not look at those kind of things. That's where it becomes inefficient portfolios. So when we are looking at only the higher upper sloped ones, which means as the risk is increasing, the expected return is also increasing, only that part of the minimum variance portfolio which is upward sloping, we call as efficient frontier. Minimum variance portfolio is everything, the downward sloping as well as upward sloping. But when we say efficient frontier, it's nothing but a line which contains all efficient portfolios. The line or curve which contains all efficient portfolios, which is efficient is nothing but higher the risk, higher the return. As the risk is increasing, return has to increase. Whereas for the downward sloped part, that was not the case. As the risk was increasing, expected return was actually falling. So the downward sloping part of the minimum variance portfolio does not fall into the efficient frontier. Only the upward sloping portion comes into the efficient frontier part. Right? And this curve keeps changing with the correlation of the securities between them. Let's say I put the correlation as -1. You see that risk can be brought down to 0. You look at the standard deviation, even 0 is existing. Right? If I have a correlation of -0.5, the slope curve is looking more, the curve is looking more and more clear. I can even bring down the risk up to what? 6%. If I am choosing the same A and B, and if the A and B is with the same return, standard deviations remaining the same, only the correlations are different. If the correlation is, if both are correlated at -0.5, I can bring down the risk even to 6%. If the correlation between them is -0.75, the risk can even come down to 4.24%. So if the correlation is becoming more and more and more negative, I can bring down the risk of the portfolio drastically. And if the correlation is +1, there is no curve at all. When there is no curve, because it's a weighted average, Now the standard deviation is nothing but the weighted average of the individual standard deviations. So because of that, you are actually not getting any kind of a diversification benefit. So better invest in the one which is having the least possible individual risk itself. Right? And the moment you are seeing, okay, even 0.8, you will see a small curve static building up. But yeah, in this case, even you did not get any leverage with 0.8 also, because nothing is less than 10. But yeah, if I make it 0.7, still nothing is less than 10. Okay, so 0.6. Yeah, now there is some combination which has gone less than 10. You see, 9.97 is possible with a 90-10 combination. So 0.6 should be the correlation. Now if I say 0.5, I am able to bring it down to 9.84. If they are correlated with 0.4, it is coming down to 9.6. So the more I am moving away from 1, I can reduce the risk of the portfolio in a more effective manner. Right? This is one aspect that needs to be looked at. So efficient frontier is only the higher side of the minimum variance portfolio, where the focus is from a risk standpoint. For each level of risk, what is the maximum possible return? So because there are two possible returns generally, the one which is the lesser possible return will make the portfolio inefficient, because no one will try to opt for it. Right? Because both should be satisfied. If two securities are having the same level of return, I'll choose the least risky one. Two securities are having the same level of risk, I'll choose the highest expected return one. That's a typical risk averse investors scenario. Right? Now, the other side of this is, how do I select the optimal portfolio? Now, whatever have been discussed here, it has nothing to do with you and me. If we see in this case, it's about the security. Right? If I put 10% in this, 90% in this, whether you put, I put, someone else put, the risk of the security is this, the return of the security is this. Right? Now, is it really feasible for you or me? See, for your risk taking level could be different, my risk taking level could be different. Right? So now I have to bring in, see, it's like when we look at our portfolio management process, identify the asset classes, identify the securities from the asset classes. So we have identified that these combination of securities are good enough as combination. Now I have to see in what combination I have to invest for this investor. See, here we are talking about, in this curve. In this curve, let me put the curve more significant. In this curve, we have risk ranging right from 8.32% to almost 15%. Right? Then each investor could be at a different level of risk. Right? I am willing to take 10% risk. See, not everyone wants a global minimum variance portfolio, right? Right? See, what we are saying from this graph is, the minimum risk that can be there with this portfolio is 8.32% standard deviation. The maximum is 15% standard deviation. Right? From 8.49 to 15, because the efficient frontier is existing from 8.32% to 15%, as the risk is increasing from 8.32% to 15%, the expected return is also increasing. Now I have to find out, what is your risk appetite? Are you comfortable at 8.49%? Or do you like 12% risk? I may like 14% risk. Right? If I like 14% risk, what is my best combination? 10% in A, 90% in B. Right? If you like 12% risk, probably I'll suggest 20% in A, 80% in B. or slightly closer to here and there. Probably the points also will, decimals also will come into picture to make it exactly 12%. So you are a 12% risk taking person. So for which my solution will be 2080. You are a 14% risk taking person for whom my solution will be 1090. So the solution will, because all these portfolios are efficient, right? As risk is increasing, return is also increasing. Not so as a risk averse investor, we said he is willing to take the additional risk as long as he is getting compensated for that, right? So, and individually risk taking levels are different for each investor. So I need to clearly identify what is the risk taking level of each of the investors. That is coming out from what we call as indifference curves. Indifference is nothing but the neutrality, right? The investor is neutral too. So for what combination of risk and return is the investor neutral? It's as good as saying the curves will be like this, where we are saying, let's say you are an investor, you don't mind investing in this, investing in this, investing in this, investing in this, which means as the risk is increasing, the return is also increasing. So you are very much neutral to all these securities, right? Probably same way you are neutral to all these securities. So these securities, the second layer securities, are like for the same amount of risk, they are giving you higher return. So obviously the lowest one is completely screened out. All those portfolios are inefficient portfolios for you as far as you are considered. So that is why I call them as low utility. Right? Though they are available in the market, you won't invest in them. Because for each level of risk, they are giving lesser return compared to other set. And across that set, you are neutral. Which means, okay, you are ready to invest in a 10% risky security if it gives 12% return. You don't mind investing in a 15% risky security provided it gives 18% return. You don't mind 25% risky security provided it gives 30% return. So you are neutral between all those things. So that's where we are getting a curve going upwards, saying I am ready to take a higher risk provided I am getting higher return. Now, what about the one which is even more above it? Generally high utility, very high utility, because I prefer that one. Right? So what typically happens is, if I try to plot all the portfolios like this, whichever is the one that is the highest, that gives me more satisfaction. Right? So the utility curve is nothing but, those are the utility curves or indifferent curves. Each curve is, as long as the portfolio is on that curve, the investor has no preference, priority. Even if it is this or this, is equally prioritizing. But if I am comparing with this versus this, you will always go for this, because this is giving more utility, more satisfaction, because it is lying on a slightly higher plane. But if there is something which he could identify, let's say here, his choice will be for the highest possible one itself. So this is what is the, so any portfolio that is lying on this line, we say he is having the least possible utility. So he will never look at it. Moderate, highest. And any investor would try to expect to get something where he is having the highest possible utility. Now, what we will do is, which is the optimum portfolio for the investor? I will try to superimpose this utility function, utility curve, on this efficient frontier. These two are superimposed. The utility curves and the efficient frontier are superimposed. wherever the highest utility curve touches the efficient frontier. So let's say I'm superimposing like this. His utility function, let's say, is getting superimposed like this. So this is where these two are touching. This is where these two are touching. So I'll say for this customer, this is the optimal portfolio. So better go for this amount of risk. You go for this amount of return. The utility is investor specific. I'll try to find out which derives, that's an economic concept, utility, which is actually a mathematical equation. Right? Probably I'll take up one example here. Yeah. The utility function is coming out, let's say, with some equation like this. My utility is expected return minus 0.5 times some constant times sigma square. Some equation. Now what is that? My utility is depending on the expected return as well as the variance of the returns. And A is a constant which suggests whether I am risk neutral or risk taking or risk averse. If it is risk averse, I have a positive value for A. If it is risk seeking, I'll have a negative value for A. If it is risk neutral, I have 0 for A. Now, if I have to look at the same thing for different types of investors, if I am talking about a risk neutral investor, let's say these are the 4 investments that are available. What will a risk neutral investor choose? If I say the utility function is given by this equation, it could be any equation, right? Again, that has to be derived from the understanding of the requirements and all that. But as far as we are concerned, if say there is an equation that is given to us saying this is the utility equation. Now, if he is a risk neutral investor, which one will he choose? 3. Third one, risk neutral guy, for him the objective is high expected return. Because in the formula, for a risk neutral investor, A will be 0. So obviously he is looking at U equal to expected R, expected return, minus 0. 0 into 0.5 into blah blah blah. It is 0. So whichever is having the highest expected return, he will be preferring that investment. For him, he is really neutral. Whichever gives highest return, whatever is the risk involved in it, he is least bothered. He wants the highest expected return. He is a risk neutral investor. So risk neutral investor will choose this one based on the utility function. Now what about risk seeking investor? For a risk seeking investor, again depending on what level of risk, this number can change minus 2, minus 3, minus 4, minus 5. If the number is minus 5 compared to minus 2, it means he is very high risk taking. Minus 2, minus 1, 0 means risk neutral. That's how the values keep moving. Right? So in this case, probably we should compute. Right? 18 and 2, let's say, okay, let's put it onto our sheet. So 18 is the return minus 0.5 A sigma squared. So otherwise I'll put all these numbers, that will make our things easy. 18, 19, 20, 18, 2, 8, sorry, 15, 30. So now if A is 0, we have already got, probably here I am saying A equal to 0, which is risk neutral. The equation is straightforward. So it's coming out as this minus this times This is standard deviation. So I have to make it 0.5 into the square. So this is still 18% because all of them A is 0. They will be still the same numbers. So in this case, a risk neutral guy will choose the third one. Now we'll take risk loving, wherein the A value is -2. Right? In this case, expected return minus A times 0.5 times sigma square. So the risk 18.04 here. So a risk loving investor will prefer this one. Right? Though there are two securities with 18% return, he is trying to choose the one with 30% risk in it. For the simple reason, average is 18%. But because the fluctuation is 30%, probably he is thinking he may get 50% also. So he wants to target that number. Average wise, they are only 18. Right? There are two with 18. But still, because the fluctuation is 30, he is thinking that there is a possibility of getting a 50% also in that. He is ready to take that kind of a risk. That is what we are calling as a risk loving kind of an investor. Now look at the risk averse investor. So the higher the value of A, he is going more and more risk averse. So from his standpoint, okay, expected return minus the A into 0.5 into the standard deviation square. So if in his case this is 17.96 and here risk averse so fine. He is going with the one which is giving him the highest utility. Right? Highest utility is coming from the second one. So a risk neutral investor, risk averse investor is preferring the second investment. Risk neutral guy is preferring the third. Risk seeking guy is preferring the fourth. Right? Because if this is the utility equation, now there could be one more. Let's say we are talking about a 4, a very high risk neutral guy. Right? Then the A value for him could be 4. Then in his case, he is preferring the first one. If he is a very high risk averse person, he is preferring the first one. A very low risk averse or risk loving person is preferring the fourth one. So different sets of investors are preferring. So there is a choice. I mean, all 4 investments are going. Depending on the profile of the investor, then how am I computing that? See, that utility equation is a curve. Now expected return minus 0.5 A sigma squared is nothing but a graph. A kind of a parabola, because there is a square involved in it. It's a kind of a parabola. Now what we are saying is, for that investor, whatever is the highest possible parabola, for that investor, whatever is that highest possible utility curve, when I superimpose it on the efficient frontier, wherever it cuts at the tangent, right, which is what is giving him the highest possible utility out of this efficient frontier, we say this is the possible investment. Now in the problem, as we have seen, 4 different investors, depending on their risk levels, we are choosing a particular investment for him. So that is matched because of the utility levels of the investor. Now if that is the utility equation, depending on the risk and return of the various investments that are available, various combinations that are available, we are trying to find out if this is the risk taking person, this is the investment, this is the combination preferred for him. If he is a completely risk taking person, a slightly different investment is preferred for him. If he is a risk neutral kind of a person, this is the investment preferred for him, which is nothing but if I am combining the utility function curve with the efficient frontier curve, whatever is the point of intersection of the two is actually the optimal investment for that particular investor or set of investors, right? See, fund manager selling that whenever he is realizing more than the expectation. See, if his intention is a zero risky portfolio, then obviously the moment it should give 18% return for him, right? That's unexpected because there is no risk. See, look at the first case. Okay, probably you take the first case. 18% is the expected. Risk is almost zero, right? So 18% is more or less expected. Let's say this is a yearly period. Yearly return is 18% with almost a zero risk. So if he, as long as he is getting 18% return, he'll continue, right? Because every year it's not one year affair for him. As long as it is giving him 18% return, he'll continue his investment. Probably if after 1 year he has observed that the return is only 10%, that is where it did not give that much of return which is expected. It has fallen below the expectations. The moment it has fallen below the expectations, it's time for him to sell off that investment and try to invest in something else. Here you have to remember one thing. This is not a technical analysis strategy where the moment you are getting a 25% return, you sell out of it. That's not the typical process which these portfolio managers follow. If it is giving more return, then it is giving more benefit to the portfolio overall. Unless I think that it will not go beyond that, only in that case he will sell off. See, there is nothing like overbought or oversold condition for him because his numbers are voluminous. His investments are in big numbers. As long as it is exceeding the expectations, the expected return is 18%. But in reality, this year it has given 20% return. So probably because it is exceeding the expectations, he is ready to buy a little bit more into it. See, booking profits, why do you need to book profit? Then okay, if he books profit, what can he do the next? He is having cash, what will he do with it? If you say there is another possible investment which is more profitable, whose expected return is 25%, probably he'll sell this off, book profit and then invest in something else, which is expected to give 25% next year. But even if this is having a 25% for next year, he'll still continue with the existing itself. So for every year, he is arriving at what is the expected return for each of them. Now, if the expected return for these 18, 19, 20, 18 is for the next year, based on the next year performance, again these numbers will get revised. If let's say the first one is becoming 25, the second one is becoming 15, and based on that again as a profile, it changes. For risk taking, the priority will change. Risk neutral, the priority will change because the numbers I am updating. In the meanwhile, the standard deviation could have changed. This year probably this first one would have become very volatile in the market. So the 2% could have become 10%. So based on that, the priorities will change. Obviously, my investment preference is changing now. So the booking of the profits here, he is not closing the fund. Right? Look at it more like this. It's as good as, probably to give a much more better insight for you, it's as good as saying, because Reliance share price has gone up, Mukesh Ambani wants to book profit, so he sold some of his shares. Simple way to structure it is, because the share price has gone up, if Mukesh Ambani wants to book profits out of it, then probably his ownership is going off. Unless he finds some other profitable business, he will not sell off his shares here. Because for him, the more and more profitable the company becomes, the more and more value for him will keep growing. Right? Same thing happens with large scale investments. Because if I sell them off, what happens is I need to find another better investment to put that entire money. So in case of big huge portfolios, what typically happens is daily buying and selling will not happen. Technical analysis will not work in that models at all. Technical analysis primarily works only for short term, small scale investments where the volumes are high. Right? Probably buy sell volumes are high. So my numbers are much lesser compared to that volume. But if I have to sell off, if as a mutual fund company I want to sell off my whole shares, it's like probably 2% of the whole stake of the company selling off. If I don't have buyers on the other side, it becomes a very huge impact. Right? So, and investing in something else means identifying a right opportunity there. It will again take another process for that. So most of the fund managers, what they look at is expected returns, expected risk. So worth for the return are less risky compared to the return, or more Sharpe ratio. Any particular security which is giving more and more Sharpe ratio, if I am combining it into a portfolio, probably the portfolio Sharpe ratio is going up, portfolio risk is coming down, portfolio return is higher, which means Sharpe ratio is higher, then he will add that security into the portfolio. Again, how much he has to add, he will decide based on which combination will give the least or highest possible Sharpe ratio in this. Whichever the combination gives him the highest possible Sharpe ratio, he would like to invest in that combination. Right? So when we are now when we bring in till now in this example, we are saying that the minimum possible risk is 8.32%. But what if and all the assets in this are risky assets? We have taken only 2, but even if I take 10 stocks, all 10 of them are risky individually. They have some level of standard deviations. But imagine any one person, will he have all 100% of money in stock market only or risky markets only? Even a Warren Buffett has a bank deposit and he maintains some money in the form of cash, or not some, a significant portion of his investment in the form of cash, which is a riskless asset. Cash means bank deposit also comes under your cash, or any government securities deposits also will come as a part of your risk-free assets. Now again, bank deposit, more reliable, highly trusted, that kind of a bank deposit, where the risk of losing is almost zero. Probably with the current set of banks, I cannot take a risk as zero. But in typical scenarios, more or less I can equate it to zero. So every person will hold some portion of his security in the form of risk-free asset. Probably even if I say yeah, risky combination, this is the best combination. With the risky combination, let's say for a low risk taking person, this is the best combination. But still, if he is having let's say 10,000 rupees, will I suggest 7,000 you put in A and 3,000 in B? Or I say, okay, you have 10,000, 5,000 you put in bank deposit. Out of the remaining 5,000, put 3,500 in A, 1,500 in B. Which means to the risky portfolio, I am bringing in a risk-free asset. That's a typical investment mechanism for any person. The reason is no one will prefer, even if you have so much of money with you, you will not put all 100% of your money in a risky investment. Right? There is a risk-free investment that is always coming in. And what happens is the risk-free investment will actually optimize your portfolio much, much better, which is what is covered in your next chapter. How if I bring in a risk-free asset to a risky asset, what is the kind of improvement that is coming to that curve? Right? We'll try to plot that curve also and observe that. So what happens is, instead of that curve, it actually becomes a straight line. We'll look at that graph also by taking in the data. But if I am bringing in a risk-free asset to a risky combination, any risky combination, probably this one or someone which is having minus 0.5, whatever is it, to this risky combination, the moment I add a risk-free asset to it, what happens is this curve will actually become a straight line. Which means the higher the amount of risk, the higher the amount of return. Right? So that is the next thing, because every individual investor will typically think of investing some portion in a risk-free asset and some portion in a risky asset. So to address that, the two fund separation theorem simply says whatever is the optimal risky portfolio, that is the same for all the investors. And now we have to go with each individual investor's preference. And based on that each individual investor preference, you will choose what is his particular optimal portfolio. So global minimum variance, efficient frontier, they are all same for all investors. But the real optimal portfolio for every investor comes only when you are looking at the utility function of that investor, superimposing the utility function over the efficient frontier. Wherever these two curves are meeting each other is what is the optimal portfolio you are defining for that particular investor. So which means there is a two-level analysis you are typically trying to do. One is evaluate the risk and return of the fund. Then compare investors' risk profile with the fund's risk profile or with the portfolio's risk profile. Wherever these two are matching, decide that this is the optimal portfolio for this particular investor. So whenever I am trying to bring in now when we are bringing in a risky asset, that is what is the context of the next chapter. When we are bringing in a risky asset, there is a possibility of creating zero risk also, because risk-free asset is a zero. So probably what will happen is, when I bring in a risk-free asset into a risky combination, I can choose risk right from 0%. Here the risk can be chosen only from 8.49% or 8.32%. But if there is an investor with 5% risk, should I not choose him this portfolio at all? Should he not invest in A and B at all? Getting it right? If the risk appetite of a person is 5%, so should he be completely shielded from investing in A and B? may not be. So I'll say probably 50% you put in bank only. Out of the remaining 50%, I'll give you a combination. Overall, your risk will be 5% only, because for that 50% it is 0. So that is what you can bring in the investors with across the risk taking levels, provided you bring in a risk free asset into the portfolio. It could be even bonds. Some bonds are risk free because they assure fixed deposit. You know how much you will get. There is no fluctuation in the final value. They are like risk free kind of securities. So as a typical investment mechanism, I'll say put 50% of your money in FD, which is like risk free almost, or even if there is a risk, it's a very minimal risk. So overall your risk will come down. So you can even fill in a person with 4% risk appetite with A and B. So he can get the benefits of A and B's returns, but still keeping his risk to a lower level. That is what is the advantage that comes when I am bringing in a risk-free security. That's how we'll look at the next chapter altogether. But just giving a flavor on the moment we bring in a risk-free asset. Okay, this will take in the next only. The risk of the moment, because we'll look at it with the graph plotting. The moment we look at the risk-free asset, so the line, if you see here, just as a understanding, right from zero risk level, there is a line that is going up. If you are looking at only your risky portfolio, the minimum risk is this much. There is a minimum risk of this much. But the moment I am bringing in a risk-free asset, the minimum risk is this much, 0. And probably if there is a guy with this level of risk, he is still having some return. Right? That is what is the excess benefit which a risk-free asset is bringing into the picture. We'll discuss about this. Right?